Every financial system is built on promises. Promises that money will hold its value. Promises that contracts will be honored. Promises that institutions will stand when pressure arrives. Most of the time, these promises feel invisible. They fade into the background of daily life, quietly enabling trade, investment, and growth. People trust the system not because they constantly evaluate it, but because it usually works. But history shows that when financial systems fail, they do not fail because money disappears. They fail because promises break. This is the part of finance that rarely makes headlines. Not the crash itself, but the slow unraveling that follows, the moment when trust fractures and obligations begin to fail one by one. When confidence no longer binds the system together, and promises are tested under stress. This is the real aftermath of collapse. After markets fall and liquidity vanishes, the system enters a more dangerous phase. Not chaos, but tension. Not panic, but doubt. A period where institutions continue operating, yet no longer believe in the assumptions that once guided them. This is when the true cost of collapse begins to emerge. In this phase, defaults matter more than prices. Missed payments matter more than volatility. The focus shifts from growth to survival, from expansion to containment. Institutions stop asking how much they can earn and start asking how much they can lose. Credit becomes selective. Banks tighten lending standards, not because regulation demands it, but because uncertainty makes risk unacceptable. Borrowers who once qualified easily are suddenly questioned. Entire sectors are reevaluated. Credit lines shrink and refinancing becomes difficult. This shift ripples outward. Businesses dependent on short-term funding struggle to roll over debt. Projects stall. Supply chains tighten. Even healthy companies feel pressure, not because they made poor decisions, but because the environment has changed. The system begins to cannibalize itself. As confidence erodes, institutions protect their own balance sheets first. Assets are sold not at optimal prices, but at available ones. Fire sales distort markets further, pushing prices below intrinsic value and creating losses that did not need to exist. This creates a feedback loop. Losses weaken balance sheets. Weakened balance sheets reduce lending. Reduced lending slows the economy. Slower growth increases defaults. And each default reinforces the belief that caution is justified. Trust continues to decline. Counterparty risk becomes a central concern. Institutions question whether the entities they deal with will still exist tomorrow. Even routine transactions are scrutinized. Safeguards multiply. Friction increases. Finance, which thrives on speed and confidence, becomes slow and defensive. This is where the real damage accumulates. Because while markets can recover prices relatively quickly, rebuilding trust takes years. Trust is not injected by central banks. It is not legislated by governments. It is rebuilt slowly through consistency, transparency, and time. And time is costly. During this period, inequality widens. Those with access to capital survive and consolidate. Those without are forced to exit. Entire communities bear the weight of decisions made far above them, in institutions they never chose and systems they never designed. Public anger grows. People question the legitimacy of bailouts. They question why certain institutions were deemed essential, while others were allowed to fail. They question a system that appears to protect capital more than livelihoods. This tension reshapes politics. Economic pain fuels populism. Trust in institutions declines further. Policies swing between intervention and restraint. Long-term planning becomes difficult as short-term survival dominates decision-making. The financial system does not exist in isolation. Its failures bleed into every aspect of society. Meanwhile, regulators attempt to learn from the collapse. New rules are introduced. Capital requirements are raised. Stress tests become stricter. Oversight expands. On paper, the system becomes safer. But regulation always trails innovation. Financial institutions adapt. They find new structures, new instruments, new jurisdictions. Risk does not disappear, it migrates. It becomes harder to see, harder to measure, and easier to underestimate. The system stabilizes, but differently than before. Growth resumes unevenly. Markets recover faster than wages. Asset prices rebound, while trust remains fragile. The memory of collapse lingers in behavior, shaping decisions long after conditions improve. Investors become cautious, then slowly bold again. New participants enter the market without lived experience of the collapse. Old warnings begin to sound outdated. Safeguards are questioned. Efficiency is prioritized once more. This is how cycles restart. The most unsettling truth is that the system does not fail because people forget history. It fails because the incentives to repeat it are stronger than the incentives to avoid it. Stability rewards risk-taking. Calm conditions punish caution. Success convinces participants that the system is resilient, even when it is merely lucky. And so, beneath the surface of recovery, new fragilities begin to form. Promises are made again. Confidence rebuilds. Leverage quietly increases. The system moves forward, carrying its past with it, unresolved, unforgotten, but increasingly ignored. This is not a story of villains or heroes. It is a story of structure, behavior, and incentives. Of systems designed to function under normal conditions, but strained under stress. The aftermath of collapse is where the real lessons live. Not in the crash itself, but in how societies respond. In what they choose to fix. In what they choose to ignore. In which promises are strengthened and which are quietly rewritten. Because the next crisis does not begin with panic. It begins with recovery. And with the belief that this time the system is different. And once that belief took hold, everything began to change. What people rarely understand is that financial collapses don't begin with numbers. They begin with confidence, with stories, with a shared agreement that this time is different. Markets don't rise because assets suddenly become more valuable overnight. They rise because enough people agree to suspend doubt at the same time. At first, the warnings are quiet. A few analysts raise concerns. A handful of insiders notice stress fractures forming beneath the surface. Cash flows tighten. Margins shrink. Leverage quietly increases. But the headlines remain optimistic because optimism sells, and fear, at this stage, feels premature. This is the most dangerous moment in any financial cycle because the system still appears healthy. Prices are still climbing. Wealth is still being created on paper. New investors pour in, not because they understand the underlying mechanics, but because they're afraid of being left behind. The fear of missing out becomes stronger than the fear of losing everything. And slowly, almost invisibly, risk stops being questioned. Banks loosen standards. Investors stretch assumptions. Governments reassure the public. Media narratives become cleaner, simpler, more comforting. Complexity is buried. Doubt is framed as negativity. This is how fragility disguises itself as strength. What follows is not chaos, yet. What follows is acceleration. Credit expands faster than productivity. Speculation grows faster than value creation. Financial instruments become more abstract, more detached from the real economy. Assets are repackaged, renamed, redistributed. Risk doesn't disappear, it merely moves, hidden inside structures few people truly understand. And the most important thing happens quietly. Responsibility becomes diluted. When everyone owns a piece of the risk, no one feels accountable for the outcome. Losses are theoretical. Failures are someone else's problem. Profits are celebrated immediately, while consequences are postponed indefinitely. History shows this pattern again and again. Empires funded by borrowed money, corporations inflated by easy credit, housing markets fueled by belief rather than income, stock booms driven by stories rather than earnings. Each time, the surface looks different. Each time, the structure underneath is the same. And then, something small breaks. Not a dramatic collapse, not a sudden crash, just a missed payment, a failed auction, a single institution admitting weakness, a quiet admission that assumptions were wrong. At first, the market shrugs it off. It's contained. It's temporary. It doesn't affect the broader system. Those words have echoed through every major financial crisis in history. But confidence, once cracked, doesn't break evenly. It fractures asymmetrically. Suddenly, liquidity, the lifeblood of financial systems, begins to dry up. Institutions that trusted each other yesterday begin demanding guarantees today. Short-term funding becomes expensive. Overnight lending turns cautious. Small delays become big concerns. And that's when fear begins to replace optimism. Not panic, not yet. Just hesitation. Trades take longer. Deals get postponed. Investors start asking questions they should have asked years earlier. Valuations are revisited. Balance sheets are re-examined under harsher light. And the answers aren't comforting. Leverage that once amplified gains now magnifies losses. Assets once considered safe reveal hidden correlations. What was diversified turns out to be concentrated. What was liquid becomes illiquid. This is the moment when markets realize they were pricing perfection in an imperfect world. And correction is unavoidable. Prices fall, not because value disappeared overnight, but because expectations finally collided with reality. Margin calls for selling. Forced selling pushes prices lower. Lower prices trigger more margin calls. The feedback loop tightens. This is where narratives flip. The same media that celebrated innovation now demands accountability. The same leaders who promised stability now urge patience. The same investors who chased upside now rush towards safety. But safety is scarce when everyone wants it at once. Cash becomes king, not because it yields returns, but because it preserves survival. Governments intervene. Central banks inject liquidity. Emergency measures become normalized. And still, the damage spreads. Because financial systems are not machines, they are networks of trust. Once trust breaks, repairing it takes time. Sometimes years, sometimes generations. Businesses fail not because they were poorly run, but because funding disappears. Workers lose jobs not because demand vanished, but because credit froze. Entire industries contract, not due to inefficiency, but because momentum reversed. This is the hidden cost of financial excess. The pain is never evenly distributed. Power recovers first, inequality deepens, anger looks for villains. But crises aren't caused by one mistake. They're built by incentives that reward short-term gains over long-term stability. After every collapse, rules tighten and caution returns. Over time, memory fades, safeguards feel restrictive, and risk creeps back in. Technology evolves, markets change, but human behavior doesn't. Fear, greed, and denial repeat the cycle. Financial history doesn't repeat by chance, but by consequence. Welcome to Cash and Chronicles, where money, power, and history collide.